Let us imagine this. On Monday morning, the Strait of Hormuz closed. By Monday afternoon, oil hit $110 a barrel. By Wednesday, $128. The biggest supply shock by volume since the 1979 revolution, and every analyst on television started screaming about the death of the dollar. They are wrong. By Friday, the dollar will be stronger than it was on Monday. This has happened 7 times since 1974. Every single time, the same handful of people got richer. Here is the trick. The cable hosts will spend the week arguing about Iran, about gas prices, about who started it. None of that matters. There is only one question that explains a 50-year pattern, and it is the same question we ask in this room every week. Who profits? Not who suffers at the pump, not who gets blamed on the Sunday shows. Who, by the time the Strait reopens, will be measurably wealthier than they were on Monday morning? The answer has been the same name on the same building since Gerald Ford was president. October 1973, Cairo. Anwar Sadat launches a war on Yom Kippur. The Arab oil exporters embargo the West, and crude quadruples in 5 months. American newspapers print pictures of empty gas stations and call it the end of the American century. It was not the end. It was the beginning. Within 12 months, Henry Kissinger had flown to Riyadh and signed a piece of paper that turned the catastrophe into the greatest financial moat any country has ever held. We will get to that paper. 1979. Different country, same trick. The Shah falls, Khomeini lands in Tehran, and oil doubles again. Paul Volcker takes over the Federal Reserve and raises interest rates to 20%. The newspapers say he did it to fight inflation. Read the meeting minutes. He did it to defend the dollar. The oil shock had loaded the gun. Volcker pulled the trigger, and the dollar came out of the 70s as the only currency anyone wanted to hold. 1980. By now you might be noticing a pattern. Saudi Arabia opens the taps on purpose. Crude collapses from $115 to $26. Half the American shale industry goes bankrupt. The Russian ruble loses 60% of its value. Every headline calls it a Saudi attack on America. Look at where the money went. Russian oligarchs panic-bought US treasuries. European pension funds rotated into dollars. The Saudis, who supposedly lost the war, ended the year with a larger US Treasury position than they started with. 3 shocks, 3 decades, 1 winner. Here is the paper Kissinger signed. June 1974. A small US delegation flies to Jeddah. The deal has 2 halves, and the second half is the only one that matters. Half 1. The United States will sell Saudi Arabia weapons, and the United States Navy will protect Saudi oil fields against any foreign threat, forever. Half 2. Saudi Arabia will price every barrel of oil it sells to anyone, anywhere on earth, exclusively in US dollars. Not reals, not gold, not a basket, dollars. By 1975, every member of OPEC had signed an identical clause. The dollar became the only currency in the world you could legally use to buy the only commodity in the world every economy needed. Set up the system as it normally works. A factory in Germany needs oil to run. The factory earns euros. To buy oil, the factory's bank must first sell euros and buy dollars. A shipping company in Japan needs bunker fuel. It earns yen. To buy fuel, the shipping company's bank must first sell yen and buy dollars. A power plant in India, a steel mill in Brazil, an airline in Kenya. All of them, every day, must first acquire dollars before they can buy the one thing keeping their economy alive. The dollar is no longer a currency. The dollar is the receipt you need to enter the building. Identify the actor who benefits. The United States Treasury, not the American consumer, not American industry, the Treasury. Because all those dollars the Germans and Japanese and Indians had to buy, those dollars now sit in foreign central bank accounts in New York, and there is only one safe thing to do with them. You buy United States government debt. The Saudis call it recycling. The Kuwaitis call it recycling. The Federal Reserve calls it recycling. It is not recycling. It is a closed loop where every barrel of oil sold anywhere on earth ends with a foreign government lending money to Washington. Show the lever they pull. The lever is the price of oil itself. When oil goes up, more dollars are required to clear the same physical volume of crude. More dollars demanded means more dollars hoarded, means more Treasury bonds bought, means lower yields on U.S. debt. Read that sentence again. When oil goes up, U.S. borrowing gets cheaper. The thing that hurts the American driver helps the American government. They are on opposite sides of the same trade. Show how the benefit compounds. The 1974 deal was supposed to last a few years. It has lasted 52. In that time, the United States has run a federal deficit in 47 of those years and accumulated $36 trillion in national debt without the bond market ever once refusing to lend. No other country on earth could do this. Argentina has defaulted 8 times trying. Greece nearly took down the euro. The reason America gets away with it is sitting in a tanker off the coast of Oman right now. Every oil shock since 1974 has refilled the Treasury's borrowing capacity, not drained it. 1979 funded Reagan's defense buildup. 1990 funded the savings and loan bailout. 2008 funded the bank rescue. The pattern is so reliable, the Treasury practically schedules its auctions around the OPEC calendar. Show who pays the cost. 3 groups, and the third one will surprise you. The American driver pays at the pump. The European and Asian importers pay an exchange rate premium on every barrel. And the developing world, every country that holds dollar-denominated debt, pays a margin call. When the dollar strengthens during an oil shock, the debt of Egypt, Pakistan, Argentina, Ghana, all of it gets heavier overnight. A Pakistani textile worker has never heard of the petrodollar system, and the petrodollar system just took a percentage of his wages. Riyadh charges polite prices. Washington collects the tax. Karachi pays the bill. The mechanism in one sentence. The petrodollar is a global subsidy paid by every oil importing economy directly to the United States Treasury, denominated in the suffering of whoever is poorest at the moment. Back to this week. The Strait is closed. Oil is at $128. The dollar index is up 2.5% in 3 trading days. Now follow the receipts. Saudi Aramco, market cap roughly $1.8 trillion. Just watch the per barrel value of its proven reserves jump by approximately $400 billion on paper. The Saudi Public Investment Fund, which owns Live Golf and a chunk of Lucid Motors and a slice of Uber, will recycle a meaningful portion of this windfall into U.S. Treasuries before the quarter closes. That is the deal. That has always been the deal. The United States Treasury just sold $58 billion in 2-year notes at a yield 14 basis points lower than last month's auction. Foreign demand was the highest in 2 years. Lower yield means cheaper borrowing, means roughly $80 million in interest savings on that single auction. Multiply across the year. The Strait closing just paid for a destroyer. Lockheed Martin closed Friday up 9%, Raytheon up 11%, General Dynamics up 7%. The other half of the 1974 deal, the security guarantee, just got renewed in real time. Saudi Arabia will place an order before the Strait reopens. That order will be announced as a defense contract. It is the second installment of an oil bill that Riyadh has been paying in dollars since Gerald Ford was president. 3 winners: the kingdom that sells the oil, the Treasury that prints the receipt, the contractor that protects the pipeline. The driver in Ohio paying $5.40 a gallon is funding all 3 of them, and he thinks he is buying gasoline. Every American gas pump is a Treasury auction in disguise.